Okay, welcome everyone. Just going to give it a moment while people jump on. Okay, well let's go ahead and get started. So, good afternoon and welcome to today's webinar where we're taking a look at what to expect in the distressed real estate markets. My name is Jennifer Von Pullman and I'm the Director of Content and PR here at ATTOM. I'm pleased to introduce today's speakers who will be guiding us through this webinar. We have Rick Sharga, EVP of Market Intelligence at ATTOM, and Daren Blomquist, VP of Market Economics for Auction.com. So here's just a brief overview of items that will be discussed in today's webinar. We'll give you a quick introduction about who is ATTOM, as well as the various data products and solutions that ATTOM offers, before diving into what you all came for, which is a detailed look into the stressed housing market as consumer programs to prevent foreclosure activity expire, and then a U.S. economic update. Now, please feel free to submit your questions throughout the presentation through the question box. Please note we'll be a little stretched for time, so we most likely won't be able to answer the questions in today's webinar, but we'll definitely get back to you via email within 2 business days. And also a reminder, you will be receiving a copy of this webinar the following business day. So now a little bit about ATTOM. ATTOM is your one-stop shop for premium property data with flexible delivery solutions. Our mission is to power real estate transparency and to fuel innovation across various industries with the most comprehensive property data. Now here you can see a better picture of all the various data products that ATTOM offers. This is the ATTOM table of data elements, and it shows how we organize our data into 11 main categories. Our data is continuously expanding to offer new data sets so that we continue to offer a one-stop data shop. We have property and ownership, transaction mortgage, boundary data, valuations, foreclosures, listings, school climate risk, hazard, and neighborhood. Now, we offer a variety of data solutions to meet your business needs. ATTOM Cloud is our newest delivery solutions, which is where the ATTOM Property Report solution lives. But we also offer many other data solutions to meet your business needs, such as the ATTOM API, through which much of our analytics-ready data can be delivered. We have bulk data licensing, market trend reports, real estate marketing lists through ATTOM lists, match and append services, and of course, we can mix and match any of our data and solutions to meet your needs. Our data is not one size fits all. Our flexible delivery solutions give you a choice when it comes to how you consume the data and also how much data you wish to consume. We tailor our solutions to meet the challenges and opportunities in your industry and for your specific objectives. So now with that, I would like to introduce Rick Sharga, EVP of Market Intelligence for ATTOM. Take it away, Rick.
Thank you, Jennifer, and delighted to be with you all today and to be joined by my good friend and longtime colleague, Daren Blomquist from Auction.com, which is the leading online marketplace for properties. And Daren will be jumping in with a lot of really interesting insights on what's actually happening in the market today as the foreclosure engines restart across the country. But what drives a lot of what's going to happen in this part of the industry, obviously, is what's happening in the U.S. economy. So we're going to take a look at that first. The gross domestic product, the GDP, which is the metric most economists use to measure what's going on in the economy, really has fully recovered from its bout with COVID-19. If you recall back when the pandemic was first declared, the government shutdown was put in place. We had the largest single quarterly drop in GDP in U.S. history, larger than what happened during the Great Recession, larger even than what happened during the Great Depression. That was followed by the largest single quarterly gain in GDP the following quarter, almost 34%. Now, for those of you who, like me, are sometimes challenged by basic math, a 31% drop followed by a 33% increase doesn't get you back to where you were. But we've had, 5 consecutive quarters since then of consistent growth in the GDP. And at this point, we're ahead of where we were entering the pandemic. We're probably not exactly where we would have been if we hadn't had the drop and then the recovery. But the bottom line is, overall, the gross domestic product numbers have been very, very positive since we got out of the pandemic. One of the reasons for this, of course, is the strength of the housing market, which we'll talk about in a second. Another is the resilience of the consumer. And For those of you unaware of it, the U.S. GDP counts on consumer spending for about 70% of its numbers. So the government stimulus programs that were put into place, the enhanced unemployment benefits, those stimulus checks that went out to adults across the country, a lot of that re-entered the economy and is one of the reasons why the recovery has been as rapid and as robust as it has been. As the economy has recovered, employment has almost fully recovered. This was a very unusual recession in a number of ways. The first of which was that it was sort of precipitated by government action and this pandemic instead of by any particular underlying weakness in the economy itself. Another is that it really focused its job losses on a very select group of industries. In most recessions, including the Great Recession, the last one we had, job losses across the board. Manual labor, professional managerial, blue collar, white collar, entrepreneurs, government employees, pretty much everybody lost some jobs in their sectors. In this particular case, almost all the job losses, the huge percentage of job losses came out of the service industries. So retail, restaurants, travel, tourism, hospitality, entertainment. Those are the markets that really got hit the hardest. And those are the only markets that haven't fully recovered. The chart you're looking at right now shows unemployment claims, which is the big blue bar cohort running across the page, and then continuing jobless claims, which is a dotted line that runs across the page. And you can see that both of them spiked. We went from about 3.5% unemployment, which was the lowest number we'd had in about 50 years, almost overnight, to almost 16% unemployment. And the numbers have been steadily coming down since then. And one of the things that's been an important factor to keep in mind as we go through this is the number of jobs that have been created, the number of jobs that are open. And in fact, there are more jobs open today than there are people looking for work. Ratio is about 1.5 available jobs for every one person looking for employment. So the labor force participation rate took a hit during the pandemic. We had a lower percentage of people who normally would be working who were in the workforce. That's gradually recovering, and really, most economists believe that we're going to be back to having all of the jobs that we lost during the recovery or during the recession by the end of this year. To put that in perspective, during the Great Recession, when unemployment peaked at around 11%, it took us a full decade to recover all those jobs. The end of the Bush administration, the entire Obama administration, and the first part of the Trump administration before we got those jobs back. And in this case, we'll have recovered all the jobs in about 2 years, which is just a phenomenal recovery. Not all is rosy in the economy, however, because of the supply chain disruptions that have hit globally because of the pandemic, because of the trillions of dollars that were pumped into the economy to help soften the blow of the recession, and a number of other things, not the least of which lately is the Russian invasion of Ukraine. Inflation is now at the highest rate it's been in over 40 years. The most recent numbers had us at almost 8%, which is about 4 times as high as the Federal Reserve Bank targets inflation to be. Just for fun, I also included the Consumer Price Index, the CPI, which is that dotted line that you see running across the page. And that takes out things that some analysts don't feel are all that critical, like food and energy, which, by the way, are 2 of the highest increased categories in terms of costs over the last few years. So whether you're looking at it by overall inflation or looking at the CPI, the numbers are very high, and presenting a bit of a storm warning, if you will, for things going forward. We can't continue to see inflation running at these rates. Energy prices are up about 26% year over year. Food is up almost 10%. And of course, housing is up significantly as well. And because of all that, consumer confidence is taking something of a beating. The combination of the pandemic, which is what initially hampered consumer confidence, high inflation, the war in Ukraine, all of those things have conspired to take consumer confidence levels down from a high of about 101 in this scale, which is from the University of Michigan, all the way down to about 63 in the most recent report. Remember that I said that 70% of the US GDP is based on consumer spending. So far, consumer spending has held up better than consumer confidence, but it wouldn't be a huge shock to see consumer confidence ultimately start to have an impact on consumer spending, which could sort of lead us into a slowdown in the economy itself, or potentially even a recession. And the other thing that could lead us into a recession is Federal Reserve activity. And in fact, if you look back at most recessions from World War II on, they've been precipitated by the Federal Reserve overcorrecting and trying to slow down runaway inflation, trying to slow down an overheated economy. And often in doing so, they've overcorrected and actually sent the economy into a recession. So what Daren and I are going to talk about today are certainly things that could definitely be impacted by a recession. And depending on the severity and the length of the recession, how many jobs it costs, all of that has an impact. There's usually a direct line you can connect between unemployment rates, mortgage delinquency rates, and foreclosure rates. So it's really, really important to see what the Federal Reserve does to try and slow down inflation and how aggressive they get. The good news is that Chairman Powell, in his tenure, has been fairly judicious and tends not to be overly aggressive, overly assertive in the moves that the Fed has made, and hopefully he'll act with caution in this cycle as well. There are some people claiming that a recession is more or less inevitable right now. One of the metrics that economists follow is something called a yield curve. And they measure things like long-term yields versus short-term yields. And typically, the longer the term of your investment, the higher your yield because the more risk you're taking. And if you see this line, and as it goes through that median, every time we've seen those yields reverse, so that short-term yields are actually higher than long-term yields, that we call that a yield curve inversion. And every time that's happened, we've had a recession following. It's not because of the yield curve, but it's a marker that people watch for. The recession doesn't typically happen overnight. We're very, very close to a yield curve inversion right now. And with the Fed's announcement that it's going to continue raising the Fed funds rate, a lot of people believe we're going to see these curves invert, and that we are on the brink of a recession. So it's just not something to panic about, but something to keep your eyes on as we move forward. So what's happening in the U.S. housing market this year? It's been a very strong market in 2021. But in February, we're marking the 7th straight month of lower existing home sales on a year-over-year basis. A big part of that, of course, is because we're still dealing with historically low inventory levels. And even though the press recently has been talking about inventory levels improving, and you can see that a little bit in the blue wavy line here, in that it's moving up. But really what it's saying on this chart is that even though the inventory problem is getting less severe, we're still lower in terms of inventory on a year-over-year basis, just not quite as low. In a normal market, a balanced market, there's about a 6-month supply of inventory available for sale. If you look at January of 2010, when we were in the teeth of the Great Recession, you can see that inventory levels were up about a year. So we had twice as much inventory as we normally have in a healthy market. And not surprisingly, those properties weren't selling. Prices were going down across the board. We had a lot of foreclosure activity adding to that dilemma. If you look at where we are today, we're right around 2 months supply of inventory, which is well below what we need. And that's why properties continue to sort of fly off the shelf as soon as they're listed, and why there's still bidding wars on properties in the market today. January new home sales were off 19% from a year ago. February numbers, which I didn't have a chance to include in this, they were just announced, were also down. They were down from January, and they were down from February a year ago. So we're not off to a banner start in the new home market either. And this chart I find really, really interesting. Even though housing starts have been very positive in January and February, the highest numbers we've seen in quite some time. And building permit numbers are also pretty encouraging. It looks like the builders are finally starting to come back and try to make up for the lack of building over the past 10 years. The red line here, which represents new homes that have been completed and are available for sale, is the lowest number that we've ever seen since these numbers have been tracked back in the 1970s. Simultaneously, we have the highest number of properties being sold on properties that are either still under construction or haven't even yet been started. So consumers are so anxious to be able to buy a property that they're going out and buying these properties before construction is completed, before ground is even broken. And we saw a little bit of a fall off in that trend late last year when the builders stopped entering into contracts because they couldn't commit to completion dates. They couldn't commit firmly to prices because of the supply chain disruptions we mentioned a little bit earlier. 6 months for appliances, 9 months for windows, 8 months for roofing supplies, and prices that vary 20 to 40% in any given week. So the construction industry, besides all of that, and besides a lack of available labor, does seem to be trying to come back, and that over time will start to help the inventory issues that we've been faced with. Interest rates also continue to rise, and this is making affordability more and more of an issue for consumers. Just to show you how quickly this goes, this is Freddie Mac's report as of March 17th. When the 30-year fixed rate loan had gone up to 4.16% on average. A week later, it was at 4.42%. And as we're recording this, the 30-year fixed rate loan across the country has rates of almost 5%. So the numbers are just going up and up, and this puts consumers to a certain extent at a bit of a disadvantage competing with investors for the same properties. And coupled with rising home prices and inflation, real house price growth has gone up pretty significantly. And what real house price growth is, easy for me to say, is a combination of not just the nominal increase in home prices, but also factoring in things like interest rates and wage growth and the like. So for a while, those low interest rates were keeping affordability at reasonable levels. But now that combination of rising interest rates, rising home prices, and oh, by the way, high inflation rates are really a triple whammy for consumers trying to buy a property in today's market. So because of that, I'm wondering if we're starting to see demand weakening. And I know, realtors I talk to joke about this, and they say, yep, we're not getting 30 bidders on a house anymore. We're only getting 20. But the fact of the matter is that we're seeing a couple indicators that suggest we might be starting to hit that affordability wall, and it might be starting to dampen demand just a bit. One of the criteria I look at is the Mortgage Bankers Association Purchase Loan Application Index. And while the numbers aren't falling off a cliff, if you look at the yellow line here, that's 2022, applications are running below both 2020 and 2021 numbers, which isn't a good sign if you're looking for a year's worth of growth. Pending home sales, and there was just a report that came out that said yet another month of pending home sales down on a month-over-month basis. But if you look at it on a year-over-year basis, I think it's an even more interesting story in that we're now at 8 or 9 consecutive months where pending home sales are lower than they were the previous year. And pending home sales is an index that the National Association of Realtors puts out as contracts are signed to buy properties. So again, just two indicators that might suggest we're starting to see a little bit of a slowdown in demand. The demand is very real, by the way, and will continue to be strong just because of demographics. The average age of a first-time homebuyer today is 33. The largest group of millennials, who were the largest generation in U.S. history, is in between the ages of 29 and 32. So they are rapidly and in large numbers coming to that prime age to buy a house. And right on their heels is the oldest of the Gen Z group who are turning 27 this year and starting to form households in large numbers. So that demand is going to keep coming to a certain extent. The third thing I would point out, and this is, you take this with a grain of salt, I tend to look at California real estate as a little bit of a bellwether for the rest of the country. And whether you look at it from just February or January and February combined, the state's home sales are off by about 8%. The unsold inventory index, which says it's down year over year a bit, is true. Um, we've seen the number of months go from 1.5 to 2 months. So we're seeing inventory build up a little bit. And this doesn't sound like much, but the median days on market have gone up from 7 to 9 days recently. So again, a couple things to keep in mind and just take a look at in terms of what we might forecast for the rest of the year. And just the inflationary numbers we've seen coupled with the interest rates rising have caused a couple of notable economists, including Lawrence Yun from the NAR, to drop their forecast for home sales overall for 2022. So again, just some things to kind of keep your eye on as we move forward. Foreclosures, because of the government foreclosure moratorium, and we're going to segue into Daren's numbers in just a minute, are rebounding from record lows. So we had the CARES Act mortgage forbearance program, which over 8 million people took advantage of last year. We had the foreclosure moratorium that really lasted for the better part of 2 years and prevented virtually all foreclosures from taking place. And because of that, we saw a record low number of foreclosure actions in 2021. In a given year, normally, you're going to have about 550,000 loans in some stage of foreclosure. And that's about 1% of the 55 million active mortgages in the country. Last year, according to ATTOM's numbers, we only had about 151,000. And in our database today, there's about 242,000 loans that are in some stage of foreclosure. So if you can take a look back at this all the way back to 2005, prior to the last market run-up and meltdown, the foreclosure crisis that ran through 2012 or so, and then the huge drop when the moratorium was declared. The last few months, we've started to see an increase in foreclosure actions. I believe that at least through the end of July this year, we'll see the same thing every month, which is about a double-digit increase in the prior month in terms of foreclosure activity, and probably a triple-digit increase on a year-over-year basis, but simply because the base is so low. There were so few foreclosure actions taking place in 2021, and a lot of the early activity we've seen so far are on loans that were either seriously delinquent, 120 days plus delinquent, or already in foreclosure before the moratorium was put in place. So again, in our forecast at ATTOM, we believe that it's very unlikely we're going to get back to normal levels of foreclosure activity until the very end of 2022, maybe the beginning of 2023. We'll start to see more foreclosure activity happening, but particularly in judicial states, it's going to take a while for this process to work. So even though servicers might be ready to issue foreclosure notices, it's going to take a while, for example, in those judicial states for the courts to catch up. There are court delays well beyond foreclosure actions across the country because of COVID, and there will just be delays in getting these activities ramped back up. One area we are seeing a little bit of foreclosure activity increasing is in the commercial property area. And these aren't big numbers, but just to kind of give you a scale of what we're seeing and the fact that things are picking up a little bit in an area that had less protections, in an area, candidly, that doesn't usually have a lot of foreclosure activity. So I suspect a lot of these are smaller properties that are owned by smaller investors who simply haven't had the financial wherewithal to go through what have been a couple very tough years. Overall, though, mortgage delinquencies, even though they're still a little higher than usual, are almost back to normal. In a normal year, about 4% of loans are in some stage of delinquency, but not in foreclosure. We're now down to about 4.65%. We're actually down a little bit lower than that. The MBA hasn't issued their most recent quarterly numbers yet. And a big part of the run-up was seriously delinquent loans that were part of the cohort that went into that forbearance program. Daren's going to take you into a deep dive on the outcome of what happened in the forbearance program, which, for my money, has been probably the single most successful joint effort I've seen between the mortgage industry and the government in the 20 plus years I've been in the market. But Daren, tell us a little bit about auction.com. So our participants today have an idea where you're coming from, and then take us through that analysis you've done of delinquent properties, new foreclosures, and what's happening from here out.
Sure. Thanks, Rick. And good stuff. Really a lot of moving parts in the economy and housing market right now. But yeah, auction.com, if I can say it right, is the leading marketplace for distressed properties. We auction off both properties at the foreclosure auction, which are traditionally at the courthouse steps, either the trustee sales or the sheriff sales. And we do this nationwide. We account for about 40 to 50% of those sales nationwide to third-party buyers. And I'll get into that a little bit more. We also do the REO auctions, properties that do not sell at foreclosure sale, become bank owned or REO. We auction those off on behalf of the banks as well. Those are online auctions. So, and with the foreclosure auctions, we're doing more. We're trying to bring those into the 21st century as much as we can with more online auctions. Sometimes that requires state law to be changed, but we're also doing remote bidding on our app in a lot of counties, even that don't allow the online auctions. So we're trying to make these more accessible, and have seen a lot of success with that. But certainly, I'll jump in now to the meat of my presentation, and I'm going to try to answer in the few minutes we have left here 12 questions, and these are the 12 questions, and I'll just go through these as we go and work through these. How big and bad is the backlog of pandemic distress? And so Rick was just kind of alluding to this a little bit with the forbearance programs and the moratorium. You see, and I agree that the forbearance program was incredibly successful. 8 million, and this number has actually gone up, have participated in that. The vast majority of those folks who got that kind of emergency protection have come out of that and are performing loans and are not delinquent. But what we're going to focus on is the red part of the pie there on the left-hand side. And if you add up that red part, those are folks who have been removed from forbearance or have exited forbearance and are still delinquent, but are not under any sort of loss mitigation program that would get them into some kind of payment plan where they could get that loan performing again. And then you add that with the little blue category there, that's 70,000, you get 345,000. And so the answer to this is, and the 345,000, these are not people that have been foreclosed on, but to me, these are the high risk loans that a lot of them, unfortunately, are probably going to make their way to foreclosure. And what we see, the movement we see here since the moratorium lifted in July of 2021, that number has gone up by 55%, or 123,000, from 222,000 now to 345,000. So that is a growing segment. It's a small portion of the total universe of folks that were potentially in trouble because of the pandemic. And so that's the good news. The bad news is that this is a growing segment as some of these protections lift. Another view on this is from the Philadelphia Fed, which the first view was from Black Knight, I should say. The Philadelphia Fed takes that Black Knight data and kind of expands it to the market. So their numbers are just a little bit different, a little bit higher, but I think there's value here in that they're saying that there's 964,000 loans that are seriously delinquent, not in forbearance, and then 490,000 of those are not in loss mitigation. So that number is a little bit bigger than the 345,000 because they expanded the market. But then if you they also have a very interesting piece is the folks who are in loss mitigation. There's 72% of those are not making payments. And so that's a little bit of a warning sign as well. And they do show here on the lower left, a big jump in foreclosure starts in January when some more of the protections for foreclosure were expired. And so that went up to 56,000. They came out with February numbers, which I didn't have time to update here, but those went down a little bit back to 37,000, but still much higher than what we were seeing in the thick of the pandemic with the forbearance and moratorium fully in place. So my answer to this is it's a small number. It's a relatively small number here, somewhere from 345,000 to 500,000 really high risk loans for foreclosure that are kind of backlogged because of the pandemic. And that, but it's a growing number, and so it's something to keep our eyes on, and it's not going to be a surprise when we see these foreclosure numbers starting to rise. But it's going to be important to keep those in context, and I'll talk about that in a second with what we were at in 2019 and even before 2019. And this data is actually from ATTOM. I look at the ATTOM data a lot for the foreclosure starts, and this is just to give a quick viewpoint on where we might see some of this backlog emerging first. And the colors there are percentage of pre-pandemic levels, whereas the size is the size of the number of foreclosure starts. And so you can see there, and you can go out on Tableau, my Tableau, Daren J. Blomquist, and check this out if you want to see what's happening in your area. And then jumping into the next question, how much distress is making it foreclosure? Because a big argument here is there's so much equity in the market that most folks are not going to make it to foreclosure. And I would agree with that, but we are seeing completed foreclosure numbers rise. And this is data directly from our platform, auction.com. And on the left-hand side, you're seeing by month percentage of January 2020 levels. So we were at 100% in January 2020. We dropped off a cliff in terms of completed foreclosure auctions. But those have been steadily rising, and we've seen, especially in January, there's a little pop up higher to about 40% of pre-pandemic levels. But we're still, if you look at the percentage changes, you're seeing these double and triple percent changes, as Rick was saying, but we're still well below pre-pandemic levels. On the right-hand side, what we're seeing, those are scheduled auctions on our platform. And one thing that really stands out here is the number of scheduled auctions, and I pulled this as of March 21st, and even as of March 21st, when the month of March was not completed, we were seeing scheduled foreclosure auctions on our platform for March at a higher level than they were in January, February, and the same for April. And so this is an indication we are going to be continuing to see these numbers rise in the coming months. Here's a view of where foreclosures are returning the fastest. And so the answer to that question is really in the Midwest. The green is where foreclosures are returning the fastest, the highest percentage of pre-pandemic levels, and the blue is lower. So where we're seeing the foreclosures emerge, and these are completed foreclosure auctions again, mostly the Midwest and the Rust Belt on that front. And one exception there is Connecticut at 243% of pre-pandemic levels. Don't put too much stock there. That is a very low volume state, but that stands out. And then by comparison, in New York, which is a very high volume state, you only see 21% of pre-pandemic levels. And so we're seeing the volume come back slower in states like New York, which is a judicial foreclosure state.
Hey, Daren, just for participants' understanding, when you say completed foreclosure, does that include both a third-party sale at the auction and an REO action in the event that the property didn't sell?
Yes, that's right. So the property has gone to auction, and that auction is complete. And there's one of two things that can happen. It could sell to a third-party investor, buyer. Actually, I'll get into this in a second. We're seeing more owner occupants buy at foreclosure auction. But anyway, third-party buyer, or it goes back to the bank as an REO. So one of those two outcomes. And then just looking forward again, this is a view of those scheduled foreclosure auctions, which I showed before nationwide. On a state level, where we're going to be seeing this foreclosure volume emerge going forward in the next few months are going to be states with a faster foreclosure process. And that kind of makes sense. And we're starting to see that places like Texas, Georgia, Virginia. If we look at the scheduled auctions in March and April, those are really skyrocketing, especially April. Texas, for instance, the scheduled foreclosure auctions, which these are not completed, but ones that are scheduled for the month of April are at 63% of pre-pandemic levels. Now, of course, some of those will be canceled, not all of those will happen, but that number is the highest level we've seen during the pandemic. Georgia and Virginia similarly had some pretty big jumps in April. So we expect those auctions, those foreclosure auctions in April to be pretty high volume in those states. Where we're seeing the numbers not hockey stick quite like that are the states with the tend to have a little bit slower foreclosure process, but these are high volume states, California, Florida, and Illinois. The numbers are trending higher, but not quite as quickly in those states. And then this is what I alluded to earlier. I want to make sure we're putting this in context. We're seeing some of this hockey stick behavior in terms of the numbers, and that's somewhat expected given all that's gone on. But in context, we're still at extremely low levels, and Rick showed something similar to this. But just to set the benchmark, in 2010, which was the high water mark for completed foreclosures, again on the left-hand side, we were at about a million foreclosures, completed foreclosures in 2010. In 2019, leading into the pandemic, we were down to 205,000. And so that was actually even below 2004, 2005 levels. We were at extremely low levels. And then 2020, we dropped even further to about 84,000. Again, these are completed foreclosure auctions. And then if you look at it through the lens of properties that sold that were either in foreclosure or bank owned or short sales, now adding short sales into the mix, you see, a similar kind of trend where the numbers peaked around 2009, 10, 11, 12, close to 1.2 million of those sales, and now down in 2019 to 300,000 and 203,000 in 2020. And short sales were making up a very lower portion of those total distress sales. Those have come back up a little bit, not because short sales really have increased, but because the foreclosure auctions have decreased so dramatically in the last couple of years. And then just drawing your attention to the third-party sales rate, that was going up even before the pandemic, but it really skyrocketed during the pandemic because of the supply issue. The overall market was being mirrored in the distress market, where there was very little supply available. Foreclosures were still happening on vacant or abandoned properties, but the demand, the number of buyers that were interested in that limited supply, that ratio went up, and so that sales rate went up. We'd also at auction.com like to believe that we were part of that increasing sales rate even before the pandemic, because of the transparency we bring to the foreclosure auction process. And then looking forward, we've thrown unemployment, seriously delinquent, GDP, some of these economic factors into a model, 30-year fixed mortgage rates, to try to anticipate what the foreclosure market could look at like over the longer term, over the next 5 years. And really, I see there's two, this is very high level. I'm not trying to get too specific and get out my crystal ball here, but there's two scenarios. And if we did see some kind of correction, possibly precipitated by triggered by a recession, we would see more of the green line where foreclosures rise, and they go up to, rather than around the 200,000 per year that we were seeing in 2019, around 400 to 500,000 per year. At the end of this 5-year period, potentially. But without that type of correction, and specifically in home prices where there is more of an equity cushion, we expect rates or foreclosure numbers to rise in 2022 and into 2023, getting back to pre-pandemic levels in about 2023, as Rick was saying, and then going a little bit above that because of this backlog. We're going to see some of those numbers be higher, but really flatten out at maybe the 200 to 300,000 level per year over the next few years. So those are a couple scenarios, and I think we'll learn a lot more as we see what happens, the impact of the rising interest rate, the Fed's move in terms of potentially pushing the economy into recession. Which one of those two paths we're going to be on. And then switching gears to who is buying distressed properties today, and because I think this is an important question to answer. because there is this belief based on what happened in the wake of the last recession that it's big Wall Street firms coming in and institutional investors swooping in and buying up properties to build their rental empire. That's absolutely not what we're seeing with who's buying distressed properties today. It's primarily individuals, not institutions. 98% of buyers purchased 5 or fewer properties in the last 2 years combined, not just per year. And these buyers accounted for 80% of the purchases. It's Main Street, not Wall Street. The median distance between the buyers and the properties they purchased was 15 miles for foreclosure auctions and 16 miles for REO auctions. So these are local folks for the most part. There are some exceptions, and they're buying close to where they live in many cases, and also not buying huge volumes of properties. And then what types of deals are available in the distress market? Because I think there's a lot in the audience today who are probably interested in this, in potentially buying foreclosure properties. And there's a lot on this screen. I won't try to digest it all, but this is data from auction.com, and I didn't source it here, but what we did is we used the match and append service from ATTOM Data Solutions to append public record data after a property exits our platform to see what happened to that property after the exit. And so we looked at a pretty good number of properties, about 27,000. We looked at flipping returns, what happened if the property resold after it exited our platform, and another 25,000 properties that did not resell after a year. These were properties that exited our platform in 2019 and 2020. And basically, you know, I'd say the takeaways for me are the Midwest and the Northeast have the best potential flipping returns, but across the board, you know, the advantage, I guess, of buying a distressed property is that you're getting that discount up front. That's, if you look at that column that has a 61.5%, that's a percentage of after repair value, and this is based on an ATTOM AVM of a 22 AVM, what the property would be worth in good condition after repair value is what we call it. So we're getting, our buyers are getting about a 40% discount, but then they're reselling at the 96.5%. They're reselling at about 97% of that after repair value. So the distressed properties come with distress and condition that needs to be fixed up, and buyers are doing that. And by doing that, they're realizing these types of returns. But anyway, the Midwest and Northeast have the best, highest returns if you look at percentage-wise of flipping profits. And then rentals, one interesting thing is when the rentals that folks are buying, rental properties tend to be selling at a deeper discount, 55% of after repair value versus 61.5%. And there's probably reasons for that, but again, the Midwest comes out on top in terms of the best potential rental returns that we're seeing, followed by the South. And then the West is not doing as well just because of the higher priced assets there in the Western region. And then I just wanted to give a couple examples of, you know, this is happening. People are, even during the pandemic, people were buying and rehabbing properties. I'll just read this here. This is one of our buyers, Will Wenzel, who purchased this suburban Connecticut home via an REO auction in October 2020. For about $400,000, and he spent 10 months rehabbing it, and it took a lot. I talked to him. He took a lot of time and effort renovating this property, and ran into supply chain issues, and he was putting stuff together at the day before the property was listed. But at the end of the day, he sold it for $1.5 million, and in November 2021. But you know, if you look at the before and after pictures, you see here that there's a transformation of this property. And then, you know, we also see this, in a variety of markets. I wanted to give you a variety. That's in suburban Connecticut. This is in Dayton, Ohio. I actually got to go see this property. This is Sue McCormick. She spent $40,000 renovating this property in her hometown of Dayton. She purchased it at foreclosure auction. In Ohio, you can do online foreclosure auctions, which is very cool. In December 2020 for $39,000. So she put as much into renovating as she did to purchasing it, but she sold it. It's in a low income census tract. She sold it, and both of these properties were sold to owner occupants. This was sold for $140,000, which is still affordable even in that low income census tract. It's 3.6 times the median income there. So I love talking about, you know, the folks who are doing this on the front line is very exciting to me. And then just the last few slides, I want to just hit home on not just what the trends are, but what buyers and others in the industry can do to, as these foreclosure numbers rise, to responsibly dispose of this distress. And so the first thing I wanted to address is how can we just dispose of the distress in a way that actually prevents foreclosures as much as possible and protects equity? And I think the answers to that are, number one, is we'd need to sell more pre-foreclosure. And auction.com is attempting to do that with a program we call MVP, Market Validation Program, that allows homeowners who are delinquent and probably on the brink of foreclosure to put their property up for auction and see if they can get a better offer than they can on the MLS. And we're showing that about 50% of the time, we're getting a better offer through auction than the MLS. Sometimes the MLS beats us, but this way you're diversifying the marketplace, exposing the property to as many buyers as possible so that that homeowner gets the highest and best offer. And in 39% of the cases, our offer is actually above what the lender reserve is, which means that property actually probably does not need to be a short sale. In most cases, these people thought it had to be a short sale, but we're getting a high enough offer in 39% of the cases that it doesn't have to be a short sale. And then the second thing to prevent foreclosures and more on the protect equity side is just make the foreclosure auction a true marketplace that attracts a broad buyer base. And that's what we're trying to do by bringing the foreclosure auctions online, allow a remote bidding on these foreclosure properties. So you don't have to physically be present at a courthouse to bid on a property. And you may think that would appeal to the big Wall Street institutional investors, and it may, but what we're seeing is a lot of pickup from the individual buyers and even owner-occupant buyers who have a full-time job and don't have time to be going down to the courthouse steps. And so what I'm showing on the right-hand side there is that by making this a true marketplace, we're actually raising, I mentioned it earlier, we're raising the third-party sales rate. More people are buying at auction, and we're also the percentage, and this is partly the market, it's not all just auction.com, but the percentage of properties that are sold for above what is owed to the lender is now, so far in 2022, which is a limited sample, it's at 56%, and they're selling for almost $50,000 more. The ones that do sell over are selling at $50,000 more, and what many people may not realize is those are called surplus funds, and after all the lien holders are paid off, those surplus funds can go back to the homeowner, the distressed homeowner. And that, if the property was to go to REO and not sell at the foreclosure sale, those surplus funds would be lost, and only the bank would benefit from selling it down the road as an REO for that higher price point.
Hey, Daren, just to emphasize how important this point is, our data shows that almost 90% of borrowers in foreclosure have positive equity, and about 27% of the borrowers in foreclosure actually have 50% or more equity. So people very often think if you're in foreclosure, you're underwater on your loan, or you're in that kind of financial dilemma, but you're really not. And auction.com is doing a great service here. But I'd also encourage any of the agents who are participating in today's webinar to take a look at this and understand that you have the opportunity to be reaching out to these distressed homeowners in the earliest stages of foreclosure. And that's how a lot of agents use ATTOM's Realty Track website to identify pre-foreclosure property owners and remind them they have options, and they have much better options than losing everything to to an REO action at the end of the day. So didn't mean to disrupt what you were talking about, but I think this is a really, really important point.
Absolutely right. Yeah, and I didn't want to make this too auction.com centric. We're trying to do our part, but certainly there's opportunity for others in the marketplace to do this, to encourage those pre-foreclosure sales. And on the marketplace, that's pretty much in our court, I guess. But all right, let's move on. And then how can distressed disposition promote homeownership, which it's kind of might be a counterintuitive sounding question. Like, these are people losing their homes. This is not a great situation when foreclosure happens. However, what we're seeing, and again, this is using the ATTOM data, looking at what happens to properties after they exit our platform, is that we're showing that after a property sells as a foreclosure sale to a third-party buyer, and this is on the left-hand graph there, and then it resells, so it's flipped. 72% of those flips are owner-occupied. That's based on the ATTOM public record assessor data that indicates the owner occupancy of the property. So 72% of those are owner-occupied after they're resold. And we compare that to if a property does not sell at foreclosure sales and goes to REO, and then that REO resells, we're looking at those as well, and only 58% of those are owner occupied. So we actually see a better owner occupancy rate when it sells early on in that foreclosure sale. And I would say probably a pre-foreclosure would be similar. We haven't looked at that data, pre-foreclosure sale. And this is, what stood out is we divided this up by census tracts, again, using the ATTOM data, census tract data, and also FHFA data on low income census tracts and minority census tracts. And we see similarly pretty high owner occupancy rates on those flipped properties after they're sold at foreclosure auction. And if we extrapolate this to the market and just look at properties that were sold to owner occupants in 2020 and 2021 after being originally purchased at foreclosure sale, we're coming up with about 141,000 properties. And so that's not going to solve the housing crisis or the housing shortage crisis, but it's a bite out of that elephant in terms of trying to solve that problem. It's a piece of the puzzle. And the average sales price on those, even though these properties are being renovated, they're still selling at well below the overall market price, about 32% when they're selling to those owner occupants. That's the right-hand graph. That 141,000 is the far left bar there. And we were seeing this happening before the pandemic. I've combined the pandemic years because the volume was lower, and the 2021 numbers have not all come in yet. So that number will actually go up. And then how can distressed disposition improve neighborhoods while preserving affordability? So when I showed the previous slide, a lot of times the first question is, well, yeah, these are neighborhoods that are being gentrified, right? They're investors coming in and fixing up the properties, and all of a sudden the people who live there actually can't afford them. And while that is happening in some areas, we do see a lot of the properties that resell in these neighborhoods. And this is on the right-hand side here. We're looking at the price to income ratio. Overall, all of these renovated foreclosures are selling for 3.4 times the median family income in the surrounding census tract. So the people who live in that census tract, their median family income, the prices that these properties are selling for is 3.4 times. In the low income and minority, it is higher. It's closer to 4 times the median family income, but that's still below. If you look at the nationwide median family income of $77,000, that's almost the average sales price. And these are all averages, not median, by the way, in terms of the sales prices. But the sales price is about 5 times the median family income nationwide. So these, I would say, are still more affordable than the overall market. And the left-hand graph there is just showing that these properties are being and I made this point earlier, but they're being bought for around 58 to 60% of the after repair value, but they're being sold for close to 100% of the after repair value. And so this is an indication to us, even though we don't know how much everybody's spending on renovation, but we know that this is an indication that these are being well renovated, and so their properties now being sold in good condition and improving the housing stock in the market. And so, yeah, a lot of data there, but that's my last slide. Jen, if you want to take over.
Thank you very much. And Rick, I believe you had, did you want to speak to this slide on your closing thoughts?
Sure thing. I think it's what you're seeing now. And I think Daren and I are pretty much in agreement on everything we presented today. These are just some recap of what we talked about. The economy is still strong. There are absolutely signs, however, recession is at least a possibility, so it's something to keep in mind, keep your eye on. Global events are going to make inflation harder and make it take longer for the Fed to get under control. Russia's invasion and supply chain disruptions. We have some more issues with COVID in China that will affect the supply chain. They're going to continue to impact energy, food, and material prices. We have a triple whammy for home buyers in terms of inflation, higher mortgages, and rising home prices. That's going to have an impact on affordability, and I believe, will probably start to dampen demand from home buyers. We'll still have strong demand. Investors will actually continue to have a strong influence on home sales. And because a lot of investors buy with cash, the higher interest rates on mortgages might actually play to their favor as we get into later in this year. And then, as Daren and I both talked about, foreclosure activity is definitely going to increase steadily. Probably won't be back to normal levels until the end of this year or early next year. It's going to take a while for the backlog to work its way through the system. I believe, and I think Daren's numbers showed this very, very strongly, that we're going to see a higher percentage of pre-foreclosure sales and third-party sales than in previous cycles, which probably means less REO inventory coming through. And then interesting to remember that local investors can convert foreclosures into very much needed affordable housing and are doing a great job. So despite the fact that investors, typically mom and pop investors, are often vilified in the press and government circles, they're actually contributing to the improvement in neighborhoods and the availability of properties that are much needed. As Jennifer mentioned earlier, if you'd like to submit questions, use the question panel in the go to webinar menu. And Daren and I will do our best to answer all those questions within the next 2 business days. I know I'm taking your spot here, Jennifer. I hope that's okay.
No. Go for it. No, thank you. And thank you guys both so much. That was very insightful. So thank you again, everyone, for joining us. Please visit our website at atomdata.com for more information on Atom and to keep up to date on the housing market as well as the current climate of the market. Also, just another reminder, the webinar was recorded and will be emailed to you. Thank you all so much.